Someone told me that you came to our office and you're trying to climb a huge wall outside my office. हुआ था ऐसा कुछ? You had to climb a 15 feet wall.
No, it was not 15th feet, Nikuch. I was already late for the meeting in the adjoining premises. I had no choice but to go.
We actually climbed that wall, 12 feet wall. अरे उल्टा आ जाता यार. You could have just taken the U-turn and gone back.
समय नहीं था, नहीं तो आ जाता.
And I'm convincing Sandeep Sarwal, who lives on the other side of the wall. It is not like a Uchana wall or something. It's like a simple wall in our compound. He's struggling to, he said, I can't come because I have to take a U-turn and come. That 10 minutes more. And Mayuresh Joshi climbed that wall. You climbed that wall, right? Disclosure.
Climb that wall and the market is climbing in the wall of worries, Nikuch.
No, you climbed the wall. That is more important, boss. At this stage, you climb a 12 feet wall.
Yeah, I could do that.
And somebody was with you whom you made the climb the wall.
Sorry?
There was somebody with you, you pushed him to climb the wall. हमारे कंपाउंड में क्या होता है हमें पता होता है ये जर्नलिस्ट एट द एंड ऑफ द डे
I like how it's all spreading right now, but given the fact that the markets are climbing the wall of worry, Mayuresh, like you said, but where are they actually parking their bets at this point in time, or where you think they should park their bets at this point in time, given the fact that we've seen sizable correction? And let's be very honest, India growth story is not going anywhere. The fundamental story of India is pretty intact.
No, absolutely. I think no two ways about it. And therefore, I think the consensus call that remains on the street remains with the BFSI space. Even what we see on our sector rotation graphs, BFSI still seems to be the strongest sector and is still placed in the strongest quadrant of the market, which means earnings should keep on continuing growing at a good pace. Obviously, it's a consensus call in terms of the sector as a whole. But generally, I think this sector should do well. Valuations are not too expensive as we speak. And if earnings are getting backed up in the next few quarters, every hope that if the rate cycle starts coming down in the second half of this financial year, there is additional impetus that probably comes through as far as earnings is concerned. And I think the kind of quality that we probably have, specifically in frontline leadership stocks, they should be able to perform well. Asset quality pressures are coming off. We are probably expected to see reasonable amount of credit deposit growth. The CASA deterioration is probably behind us as we speak. Provisioning is very well done in terms of the restructured assets. They're very well accounted for slippages as well. And therefore, I think the system probably looks geared for decent and very strong growth going forward. So Kotak, ICICI Bank, leadership stocks in the private space, brilliant ratings and rankings as we see it, should continue doing well. State Bank, Bank of Baroda within the public sector enterprises should also continue doing well as far as earnings are concerned.
Mayuresh, if you bought SBI at the peak of COVID pandemic, you actually hit a home run. Similarly, with the Can Bank, Union Bank, all of them are up 3-4x from there, right, Kunal?
Yeah.
3-4x, right? But if you bought Kotak Mahindra Bank at the peak of the pandemic, you actually did not enjoy the fruits of this bull market. For next 6 months, what is a trade, Mayuresh? And for next 12 months, which is a good investment?
So Nikunj, as I mentioned, I think we discussed this last time as well. I think Kotak is probably coming there right up the charts as we speak. Again, if you just dissect how Q3 numbers had played out for Kotak, the NIMs were at 4.93%, which showed a sequential increase. The expectations in terms of the embargoes that were laid out, both in terms of credit cards as well as unsecured personal loans, I think that is largely behind us as well. The book that they're probably taking in from a large private bank, that should start playing out in Q4 as well. And therefore, the CASA deterioration that we've seen for the system as a whole, also for Kotak Mahindra Bank, should probably start bottoming out. NIMs should get maintained in this range itself and improve, as I said, with rate cuts expected in the second half of this financial year. And therefore, the entire book and the construct of the book that we're probably looking at, strongly placed in terms of both credit growth that is expected, deposit growth, which should be decent enough, supporting NIMs. And therefore, return ratio should improve drastically as we speak, 4 to 8 quarters. At the same time, looking at prospective ratios, they have come down. And therefore, I think the key parameters that you're probably benchmarking Kotak with the other larger private ones, I think it should largely stand out. So remain extremely optimistic on Kotak and ICICI Bank from the large private names.
Astral 15 rupees higher, and Mayuresh, there is a whole talk of where the pipe stocks are moving, where the wire stocks are moving, and I'll just put a description here, guys. So wire companies today have capex, which is called as gross block. How much you invest. Mayuresh, you can interrupt. I'm trying to simplify it, and I could be completely wrong. You are the expert here. What is called as gross block? Whatever capex they've done in the last 3 to 5 years, they have got additional revenue of about 5 to 7 times on that. So, for example, Polycorp did a gross block of 1,500 crores. They've got a revenue of 7,500 crores. The margins there are anywhere between 15 to 20% because it's B2B, B2C. So everybody is saying that by doing little capex of 1,000 or 1,500 crores, we can get 7,000 crore turnover. Why? Because Ultratech is trading at what would be called as a commodity company. It's not getting a great P multiple. So builders are coming out and saying that we will try and change the complexion of Ultratech. Take the cyclicality out, and that I think the attempt here is. And what has happened in Asian Paints, could that happen in the wire industry? I don't know. All I know is that the P multiples will get crushed because competition will intensify. Mayuresh, I've tried my best to sum it up, but am I right if I say like this?
Absolutely good. And again, I think look at the big picture, right? I think the entire home wire and cable industry is around 21 to 25,000 odd crores. That's the broad gauge that we're probably getting. 65 to 70% of that market is organized. So to a large extent, the unorganized players form 30% of the overall market, which is around 6 to 8,000 crores. The other aspect is that this industry is growing around 7 to 8%. So this industry always grows in terms of how the GDP of the country is expected to grow. Now, when new players start coming in, and you're absolutely bang on this, Nikunj, I think the expectation here is that there might not be a pricing dent that we've probably seen like the paints industry, because a large part of this market is organized. The newer players will have to create a separate ecosystem in terms of distributors, dealers, or tie up with the existing ones that are probably doing the business at this juncture. But yes, there will be some element of undercutting that probably happens. Higher dealer commissions that do get passed on as well. And therefore, competition intensity is something which will drag what we organize players' profitability to a large extent. You're absolutely right, I think. You need to be very, very specific when you're probably talking about cables, wires, but the industry probably suggests that significant amount of growth and a compounded growth over the next 5 to 6 years probably looks steady state, no great re-ratings that are probably expected in any of these segments.
That's the take coming in the cables and wire space. No doubt that that's the one space that will see some competition also creeping in. But along with that, I wanted to talk about the EMS space actually. Mayuresh, given the fact that today you have a note which is saying that room air conditioners and electronic manufacturing services sector is poised for significant expansion, this on back of favorable macro tailwinds as well as shift towards the domestic electronic goods. And we've seen actually a lot of government impetus coming in for the EMS space in particular. We've seen that sort of a rally play out. Then we've seen the cool off also in most of these players. What's your take? Do you think it's a space that you can still look at and there will be a bright prospect going ahead?
So again, I think the market size is expected to triple from here on. So I think there is significant scope for the EMS players to probably participate in the market opportunity that comes through. But again, I think as a construct, if you're looking at the OEM players, they're probably doing outsourcing work for a lot of OEM makers to a large extent, where margins are very, very thin. So you're probably looking at single-digit margins happening on this front. I think the more innovative part that comes through here is the ODM part, which is the original design manufacturing, which has started creeping up, but is still very, very minuscule for a whole host of EMS companies. There the margins are better, but the expectations in terms of how much of an ODM share will they be able to garner in terms of their overall revenues as a percentage of top line as well still remains circumspect. And therefore, I think some significant margin expansion is something that is to be believed is might not happen. The other way in terms of looking at these things are how valuations are probably played out for a whole host of these EMS players. We're talking about Dixon, Amber, Avalon, Sigma, SGS. And therefore, I think valuations still remain very, very expensive, and earnings do not match the kind of expectations that the street has probably put forth. I think these stocks might actually go into a long, long time consolidation. I think the better play, as we see it at MarketSmith India, is consumer durable, the core consumer durable plays. So air condition manufacturers, as an example, right, have done exceptionally well, but the momentum there can very well continue. For a stock like Blue Star, as an example, let's look at the cabling part of the business itself. So the HVAC market itself is expected to triple from here. Almost $6 billion is expected to be around $18-19 billion as we head into the next 7 to 8 years. And therefore, a stock like KRN refrigeration, I think, might do exceptionally well, in my opinion, if somebody has that longevity and expectations of how the industry will probably grow. So my own sense is that a few select core consumer durable stocks might actually do well. EMS players still expensive in my opinion, and they might probably struggle if earnings do not compound at a pace which the market expects, which is quite significant at the current juncture.
But what's your take on the entire auto space? And leaving this news piece aside, would you be looking at it?
Very, very selective, because I think what you're probably looking at in terms of Trump tariff impositions, and if they are expected to continue at the rate at which Trump is proposing, I think it's going to take a significant hit. A lot of global OEM there. Obviously, which sees that the EV adoption is probably slowed down globally as well. And therefore, the kind of accelerated R&D investments done on a lot of EV mobility platforms by a lot of global companies, including JLR, including Volkswagen Group, including the Mercedes Group as well, and BMWs. I think you're probably expected to see some element of cash impairments happen this year at least, till demand probably starts coming back. Until that happens, I think you are expected to see a lot of these companies take a hit on their balance sheet. And therefore, domestic-oriented companies actually might continue doing well. Two-wheelers in particular might continue doing well. In our opinion, I think TVS Motors, decent set of numbers till Q3, still expecting margins to remain steady. Cost optimization programs will ensure steady margins probably come through. New models, new platforms that they're probably introducing, new geographies that they're now entering into will give them added impetus in terms of volume growth and therefore operating leverage onto their balance sheet. Little bit expensive, but rating rankings, institutions holding, as we see it in Canslim, looks super. So I think two-wheelers, TVS probably stands out. Maruti might probably act as a shield, because I think they've got a perfect mix in terms of entry level, mid level, and the hybrids and SUVs that they're now developing. The after sales service distribution is a very important component for the auto industry as a whole, and therefore this is one stock that we'll keep on our watch list as well. And outside these two, I think Swaraj Engines, if anybody's holding that stock, should continue holding. Fabulous set of numbers for this year itself. The volume growth in terms of engines has grown exponentially over the last 3 quarters. Realizations have been better. Balance sheet is very, very healthy. The parent pedigree is very, very strong. And therefore, return ratios look extremely, extremely attractive as well. So I think Swaraj Engines, if anybody is holding as a play in terms of farm equipment, rural recovery, I think can also be looked at.
Selective plays are coming in the auto pack. On that note, thank you so much, Mayuresh, for joining.